So ChatGPT, what exactly is a shareholder?
A shareholder is someone who owns shares in a company, meaning they have a stake in that company. Essentially, they are partial owners of the business, and their ownership is represented by the number of shares they hold. Shareholders can earn profits through dividends, a portion of the company's earnings, or by selling their shares if their value increases. They may also have voting rights on certain decisions made by the company, like electing the board of directors.
Hey everybody, welcome to Private Equity Rundown. I'm Bill, the company's expert. I apologize for my late start today. Things were beyond my control there for a bit, but we're here, and this is episode 3. This episode is called Who Really Controls a Company? The Truth About Ownership and Power. So if you were joining me so far in this series, we were talking about companies, corporations in particular, and the ownership of the corporation, and how a corporation works as a legal entity and as a financial entity. And we've already kind of discussed more of the financial side of corporations and how they work. Today, we're going to focus on the ownership of it, specifically the control of the organization. It's one thing to own shares in a company and get a share of the profits. It's another thing to be able to exert active influence in helping to run that company. So that's what we're going to focus on today. I see there are 16 people here. Thank you for joining me. You guys are awesome. So you'll have to forgive me a little bit today. I don't have any notes or anything. I'm just totally winging this, coming off a few meetings that were completely unrelated. So let's see if I can load all this stuff back up into my head and talk about it. Now, let's start at the beginning. So hopefully everybody understands that a corporation is a separate legal entity. And usually you give it a name and it does something, and you can assign people that own it. And so the corporation can be bought and sold like a thing, like any object, right? So just because you start a company and maybe you involve other people in its running and maybe they all collectively own it with you, you can sell that corporation. You can sell your stake in it and you can leave, right? So let's talk a little bit about some of the terminology here. The corporation is owned by owners, okay? So that's pretty self-explanatory. However, when you talk about this stuff professionally, you don't talk about owners. They throw some other terms around. For example, shareholders, directors, or stakeholders, okay? These are all different terms thrown around. Let's talk about these. If you own a part of a company, a corporation, you are a shareholder, okay? The way ownership works is that the corporation issues shares, and it can issue as many shares as it wants, essentially. What really matters is how many there are and how many of those shares you own. So if the corporation issues 100 shares and you own 10 of them, that means you have a 10% ownership of that corporation. If they issue 1,000 and you own 100, you still have a 10% ownership of that corporation. It's all about the ratio that you own. Now, if you own shares in a corporation, that entitles you to two things. Number one, you get a share of the profits of that corporation, and also you have a share in the control of that corporation. Now, last episode, we talked about share of the profits. We talked about dividends and things like that. Today, we're going to talk about the control. Okay, so if you are a shareholder, you are a part owner. Okay, that's what that means. Now, a lot of times, corporations have many shareholders. There might be one or two major ones, possibly, but there's usually numerous smaller ones. And if you think about it, if you get over about, say, 20 shareholders, it may be somewhat problematic in getting those shareholders into one room to sit around one table and have one conversation about what they're going to do. It just becomes very cumbersome. So the way this stuff works is that shareholders usually will appoint representatives of theirs to represent them when they discuss how the company's run. And those are directors. Okay. Now, a director may or may not own shares in a corporation, but a director is someone who represents shareholders when they discuss how the company's to be run. The directors usually, I don't know where this term comes from, but they're on a board, the board of directors, and you would then have board meetings. And the board meetings are simply when the directors get together, usually with other people like the CEO, to discuss how things are going and how the company is going to be run going forward. So you have regular board meetings. Now, in the Articles of Incorporation that we discussed previously, which is a document that lays out the corporation, and documents like that, you have all the details specified in how they vote on decisions. Okay, so if you have usually an odd number of directors, say 3 or 5 or more, they will vote on a topic, and it's majority rules. Whoever gets the majority of votes, meaning over 50%, so 51% or more, they get their way. And this is documented officially in the board minutes. So when you have a board meeting, the directors attend, they bring up issues. The issues often get voted on by the directors. The results recorded, and that determines what course of action will take place. And that's how the directors decide how to run a company, at least from a formal sense. Okay, we've covered the owners and we've covered directors. So hopefully everybody knows that there is a difference between an owner and a manager. A manager is someone who runs something, who manages something, right? But the manager may not be an owner. Sometimes they are. If you have your home business, you run the business, so you're the manager, but you also own the business, you're an owner too, right? So it's like 2 roles in one person, right? In a corporation, the person who runs the business, the big boss, is the CEO, the chief executive officer, and they run the business. Now, they may or may not own the business, but they certainly run it. The role of the CEO is to run the business. Usually, in most situations, the CEO will be a part owner of some kind. They will have some stake in the business because that gives them the incentive to care about it. They're not going to run the business right into the ground if the business is a big part of their income and they make money off it, right? So if you tie ownership to control, usually that helps you care about the thing that you're controlling, right? So the board of directors are the bosses of, or is the boss of the CEO. Okay, and one of the most important duties and responsibilities that the board of directors has is they hire and fire the CEO. That's their responsibility. So CEOs are not the be-all, end-all. Yes, they're the most senior person who's managing the company, but that doesn't mean that they can do whatever they like. They have to report to a board of directors, and the board of directors is their boss. The board of directors, first of all, in addition to being able to fire the CEO, the board of directors sets their compensation. So, if they can always give the CEO a pay downgrade or anything like that if they chose to. And in addition, the board is, in theory, they are checking up periodically, usually every quarter at least, on how the company is being run. The board has several different mechanisms like auditors and things like this that are feeding them information about how things are going at the company and what's going on. Like think of, for example, the accounting and corporate governance mechanism where you have, auditors and this kind of stuff by law to present financial statements and stuff like that, what's going on with the company. So that's being fed directly to the board of directors. And also the shareholders a lot of times, because the shareholders are owners of the company, so they have the right to know what's going on with it, especially things like the financials, right? Okay, so the CEO reports to the board of directors, and the directors are representatives of the shareholders, who are the owners of the company. I introduced a term earlier called stakeholders. Hopefully you may or may not have heard of that term. Wow, there's 30 people here. That's amazing. I didn't know 30 people would be interested in this. A stakeholder simply means someone who has a stake in the business. They care about the business in some way, right? So stakeholder encompasses like everybody that's kind of affected by the business. For example, the owners are stakeholders. The directors are stakeholders. The managers, like the CEO, are stakeholders. The employees are stakeholders. The person who lives next door to the company is a stakeholder. The customers are stakeholders. The suppliers are stakeholders, right? If the company was to go bankrupt and just cease operations, it would affect all of these people. It would affect the owners, it would affect the customers, it would affect the employees, it would affect possibly the public or maybe the community where the business is located. So all of these people are considered stakeholders. That's what that term means. It just means anyone that has a stake in the business that is affected by it. That's a different thing to shareholders who are owners of the business and directors who represent the shareholders. They could be shareholders themselves. Usually they are, right? And every other person I mentioned. So that's how this works. Now, one big question, okay, beyond just the structure that we've laid out here, okay, is like, this is the theory, and this sounds really nice. The shareholders who own the company decide how it's to be run. There might be a lot of them. Let's say there's 31 shareholders. They don't all equally own the same number of shares. Some people might own more shares, some people might own less, but let's pretend there's 31 of them, a nice round number, right? Very hard to get 31 people in one room to discuss something together properly, like on a round table, around a table, right? So they represent, they vote on directors. So let's say there are 3 directors that represent the wants, wills, and needs of 31 shareholders. So every quarter or so, could be more often, could be less often, but usually every quarter, there's a board meeting. The 3 directors meet to discuss how things are going, and the CEO is there too. Okay, and there might be some other people, like people taking the minutes, and the financial person might be there and stuff like that. But basically, it's between the director and the CEO. And they discuss how things are going and how things are, what's coming up in the near future and how things are going to go, what should be done, right? And you might be wondering how a shareholder exerts influence over how the company is run if the shareholder is not at these meetings, nor do they have any other active part in the business since they don't work for it. How does this work? Well, oh, and by the way, I will get to questions, but I'm just going to get through this first. Okay, so first off, usually what happens is anything that's going on with the business, say there's a new opportunity that presents itself, or there's been some recent development, maybe some bad news, or maybe there's like a huge decision that needs to be made as to whether they sign a contract or not, something like that. Usually that comes to the CEO. The only reason shareholders or board members would know about it, a lot of times, is if it came through the CEO. The CEO says, this came up this week, this is an opportunity. So, and I'm talking mainly about private companies here. I don't know if we actually specified that, public companies or private companies. Same thing, it's just the public companies you can buy and sell their shares on the stock market. Private companies you can't. So how would a shareholder know what's going on so they would be able to have an opinion on it? Well, usually the CEO communicates what's going on to both the directors and the shareholders. In very small companies, if there's only 31 shareholders, the CEO could conceivably send an email out to all the shareholders too. But in larger companies, usually the CEO communicates directly to the board members and like the directors. And then the directors are kind of the intermediary between the shareholders and the active running of the company. So like the CEO. So the CEO tells the board disseminates this information to all the shareholders. There's all kinds of ways of doing this. You have annual general meetings, you have shareholder meetings, all this kind of stuff where shareholders can show up and they get a briefing and they get their opportunity to speak and talk to the directors. Okay, now let's say the CEO has informed the directors by email or whatever, or just by phone or conversation, that something has happened. There's an opportunity. We have an opportunity to partner with somebody. Should we do it or not? This is a big decision. It's going to affect the company in a big way. What should we do? And the CEO says, I'd like to agree to this. But that's a decision that the board is probably going to want to sign off on and approve. So the CEO communicates this with the directors, the board of directors. The board of directors disseminates this to the shareholders. The shareholders read about it or get an email or something like that. And the shareholders will form an opinion on it. Is this a good thing? Is it a bad thing? Should we do it or should we not? Right? Maybe some shareholders want to exert their influence because they have a very strong opinion. So they can do this. So let's talk about that. The shareholders, basically, what they'll do is almost like you go to your local politician to represent you in the government. You would go to your director. You might not have a specific director, but you go to one of the directors and explain what you think and say, yes, I agree or I don't agree, right? And hope that the director will forward your views and represent your views at the board meeting. Now, shareholders get to appoint directors. They get to vote in directors. So presumably you have directors there that do represent the general thinking of most of the shareholders. That's the idea. But a shareholder can always try and influence a director directly by talking to them, by persuading them, by threatening to sell their shares. Okay, they'll say, if you don't do this, I'm out. Okay, that can have consequences, for all these parties. They can, I don't know if you've ever heard the term activist investor or activist shareholder. They can try and lobby, they can try and persuade the directors to sort of forcefully argue for their cause. The shareholders can vote on directors. So therefore, you could say to a director, you better represent my view or I'm going to be voting against you next time we get to vote on who the directors are, right? You can form alliances between shareholders and say, well, if you don't push my argument at the next board meeting very forcefully, I'm going to collude or form an alliance with all these other shareholders. We're all going to vote against you. And directors get paid for the job they're in. So, that carries a lot of weight. Or there's more exotic things that can happen. You could go outside the role of an owner and, try and do things outside of it. Maybe go to a company and talk to the company that's what were we talking about? Forming in signing a contract, some kind of partnership deal. You could directly go to that other company and try and persuade them by saying, if you do this for me, if you change the deal or you change what's proposed, then I will do this for you. Something like that. You can get all that kind of stuff going on, right? That's like activist shareholders and stuff. They do that. But they try and influence the directors. And then the directors at the next board meeting will represent the views of the shareholders. They'll take a vote on it, majority rules, and then that will get recorded officially. And then the CEO will be advised officially that this is what we want you to do. We're your boss. We tell you to do this. You do it. That's how that mechanism works. If the CEO refuses, then they can get fired or there can be other consequences. One thing that's been known is that CEOs can sometimes try and manipulate things to serve themselves. They don't necessarily like having their decisions second guessed by a board. They just want to reign supreme. So they can engage in all these subtle kind of behavior where they might delay informing the shareholders about an issue until it's too late or something like that. There's all kinds of tactics that people have used to do this. They also have a very close relationship with board members sometimes, very close personal relationships, this kind of thing. They're everybody's buddies. And that can work against the issues of the shareholders. So there's all kinds of power politics that come up in this mechanism. But that's the official process. That's how a shareholder who owns part of the company has a voice in how the company is actively run, even though the shareholder has nothing to do with working in the company. They are not part of the day-to-day operations. In some cases, if there's many shareholders, the CEO won't even know who the shareholder is. They don't know of them. That happens certainly in publicly traded companies. In privately traded companies, you even sometimes get that too, yes. So that's kind of the mechanism of how all this stuff is set up so that the CEO is run by the board is informed, the board represents the opinions of the owners of the company, who are the shareholders, and the shareholders can actively influence how the company is run. They're ensured they're not left out of decisions, and they have a say in all the decisions. So hopefully that makes sense. There are 29 people here. Thank you for joining me. That's the end of my spiel. Let's go over to questions. So Daisy says, I didn't know about the topic. I clicked to listen because you provided helpful insights when searching for a job. Much appreciated. Yes, this is a little bit different than searching for a job. I try and branch out to a couple of different areas. The first area I also cover is side hustles and entrepreneurship, which is related to job search in as much as it's an alternative method for people to have an income. Like I don't work for anyone. I work for myself. A lot of people do. And as we go into the future, it's a increasingly attractive option for a lot of people. So I cover that on a separate podcast, a separate live stream called Side Hustle Ideas. On this one, it's even more further afield from that. Private equity is an area of business that deals with the buying and selling of companies. And I believe that some of these principles can be very useful for a lot of people if they understand the concepts. Whether they work in private equity or not, you can apply this type of thinking and these type of principles to a lot of other areas. So that's why I wanted to cover it. And it's a bit of an experiment. We're only at episode 3. Alex says, I was programmed on a job interview, 7 people recruiting. Okay, so that's about jobs. Yeah, we're not talking about jobs here, unfortunately. This is about private equity. CRS says, I had a final interview. It was more interview stuff. Rob says, can you elaborate on private equity firms using back-floating rate debt on private retail outlets and forcing them to file bankruptcy? See, until recently, I haven't really been in the world of private equity. I've kind of stayed out of it. I've been a CEO of a smaller company. I reported to a small board, and went through this process. I ran their business for them for a couple of years. And, I'm not a huge private equity type person, but it's an area that I'm wanting to really expand my knowledge on. I do have a master's degree in finance, so that does help on stuff. But I'm not actively familiar with that. However, if you're up for it, Rob, let's do an experiment, okay? I'm going to pull, you know what? I don't need to do any fancy stuff with my computer. We will just do it on phone. Why not? I was going to chat GPT your question and then we can discuss it. Let's see here. It's that level of expertise I have here. Okay, let's try this again. Can you elaborate on private equity firms using back-floating rate debt on private retail outlets and forcing them to file bankruptcy?
Private equity firms sometimes use a financial strategy called back-floating rate debt to acquire and manage companies, particularly in retail. Here's a breakdown of how this works and how it can lead to bankruptcy. 1. Back floating rate debt. This type of debt involves borrowing money at an interest rate that fluctuates, usually tied to a benchmark like the LIBOR, London Interbank Offered Rate, or prime rate. The back part often refers to how the firm arranges to take on this debt after acquiring the company. These debts can have variable terms, meaning that as interest rates rise, the cost of debt also increases. 2. Leveraged buyouts, LBOs. When a private equity firm acquires a retail company, it typically uses a combination of debt and equity. This is called a leveraged buyout. The goal is to minimize the equity portion they need to invest by loading the company with debt, which the company itself will be responsible for repaying. In this case, the retail outlet, now part of the private equity firm's portfolio, takes on significant debt to finance the acquisition. 3. Bankruptcies. Due to debt loads. When private equity firms load a retail company with large amounts of debt, especially...
Does that make sense? It seems just like a specific type of leverage buyout. For people who don't know, private equity is when you buy a business, but more than that, the assumption is that you are heavily leveraged, so you're doing it primarily with debt. Okay? Now, we covered that, I believe, in the first episode of this, where we talked about how, let's say a business costs $10 million to buy, but you only have $1 million of your own $1 million of your own cash. So if you were to go to a bank, like a merchant bank or investment bank, and you said, look, can I borrow $9 million and it's secured against the value of this business I'm going to be buying with it, right? So the business itself is the collateral, right? I now have $9 million that I've borrowed to combine with $1 million of my own, so I can buy a business that's valued at $10 million. So I've only spent $1 million, but I now control a business that is worth $10 million. Okay, so that's the idea. Now, that's kind of like where the name sort of private equity comes in. It's the new term for something that was called leverage buyout. That's the term that I've always known. That's the term that, I studied in school years ago. And the word leverage is right in there. Leverage in this context means debt. You're borrowing heavily to buy something, right? And this is regarded as a good thing because if I only have $1 million, I can control something that's worth $10 million. Now, let's say I make $2 million profit. Well, $2 million on $10 million is not that much. It's like 20% profit, right? But $2 million on $1 million is a lot more. It's 200%. So if I had spent $10 million to make $2 million, it wouldn't be as good of a payoff as if I'd only spent $1 million, borrowed the rest, and made $2 million. I've essentially doubled my money. So, I mean, that's a very crude example, but hopefully you get the idea, right? Forcing them to file bankruptcy. Bankruptcy is an interesting thing. First of all, bankruptcy laws work differently in different countries. And I know in the United States, I'm not in the US, I'm familiar with Canadian bankruptcy laws. In the United States, you have Chapter 7, you have Chapter 11. I believe there's another one. Is it Chapter 14? There's liquidation is at Chapter 7. Chapter 11 is restructuring. And what was Chapter 14? It's the other one. And it basically enables you to buy something for extremely cheap. You can come in, you can buy the assets, or you can restructure it, in this kind of thing. So there's a lot of interesting and strange opportunities there for the people that want to sort of float in those circles. Almost like people who would buy a house from a government auction, right? You have houses that are foreclosed upon, and they're sold for very, very cheap. Obviously, the rules vary in different countries, so I can't go into specifics because I know a lot of people are watching me from the United States, and I'm familiar with Canadian laws and stuff on this stuff. So there's a lot of weird opportunities there where you would want a bankruptcy so you can do certain things. You could sell, you could restructure, you could strip it down. There's all kinds of stuff where, the rules of buying and selling are almost suspended because it's in bankruptcy. And a judge is sort of ordering things to happen as opposed to, having like free market economics decide, what the selling price and all this kind of stuff. There's also laws involved saying that, to prevent predatory actions, anything that like a house that's foreclosed upon, you can't sell it at a big profit. You have to sell it for very cheap, because if you were allowed to sell it at a big profit, then that would encourage all kinds of predatory actions where you would want people to go bankrupt and have their house foreclosed upon just so that you could take it and sell it at a huge profit. So they write laws to discourage certain types of behaviors, right? So bankruptcy is this weird kind of special case where for certain entities, it suspends the normal rules of business, and it may be an opportunity to get stuff for cheap or to do things that would normally be much more expensive or much harder. So there's all kinds of shenanigans that go on with bankruptcy related stuff. Personally, on a personal note, I've always tried to stay away from that because for me, it's a kind of a weird ethical gray area. I know a lot of people don't have a problem with that stuff, nor is there anything technically that says they should, but it just feels a bit weird for me. Probably because as a business guy, your whole MO is to make sure your company doesn't go into bankruptcy. So, dealing with it on a very intimate level is kind of a bit repugnant. Thanks for the tip, by the way. It's me, Jabs. Hopefully you got the tail end of the phone conversation thing better. Love the Tosu says, love the side hustle videos as well as these informative ones. I have 2 20-somethings and forward things all the time. Thank you. Well, that's great to hear. Thank you for the compliment. And that's very flattering that you're forwarding this stuff on. I'll try and do a better job. I know I sometimes am not super coherent or prepared, but that's the side effect of doing my YouTube channel on the side of like a day job. So I have to come up with a better solution for that going forward. AJ says, I have something to do, but I will press the like button for you now and catch you on the replay. Well, if you do watch this on replay, thank you very much, AJ. I do appreciate that. And it's flattering that all you guys are here listening to me ramble about this. I didn't know if anyone would show up for this topic, especially on a channel where I primarily talk about job seeking. Love says, is that even legal? All the stuff I've mentioned is legal, but there are constraints in most countries that I know of. In Canada and in the US, there are all kinds of rules and regulations for how you do this stuff, but it is legal. And you're welcome. It's me, Jabs. Greetings from Italy. Well, greetings from Canada. What's hello in Italian? Is it hola, or is that? I get confused between Italian and Spanish. I took 1 year of Spanish, like when I was like 15 years old or something. And ever since, I can't remember any Italian. It's like the weirdest thing. Hey to Tomi. I wish my name was that. Yeah, so that's basically what. Oh, is chow? Chow. Okay, I always thought that was goodbye, but in some language. But that is the word. Okay, awesome. Now I know. So that's basically what I had to say about this episode of Private Equity. We talked about the ownership. We talked about the structure of shareholders, directors, and their board, who then manage the CEO. That's who the CEO reports to. How they manage to exert influence over the CEO, and how they get their information, because if they're uninformed about certain things, they can't exactly have an opinion on it and curb the influence of the CEO. Something we didn't really get into today was the other ways that the board is aware of what's going on besides relying on the CEO to tell them, right? They've got other mechanisms that look into the company. There's all kinds of governance, and like the financials are all fed directly to them. They have to be, because they own the company legally, so they obviously need to be kept informed as to what's actually going on financially. But more than that, there are other mechanisms where they can keep tabs on non-financial elements of how the company's being run. Maybe that would be a good topic for the next episode. You know, how the board can see inside and not have to rely on a CEO for absolutely everything. If you guys have any requests for the topic for next week's episode, please put it in the chat right now. I will be covering all of this. It's hard to know where to start with this stuff. As you can tell, this is a bit homespun. It's a bit kind of off the cuff. Just I'm winging it. But let me know if you have any requests for different things you want to know about, you want me to get into, and I will take that into account. In about 20 minutes, I have another live stream, my regular live stream where we talk about job interviews. It's called Honest HR Nitrous. So if you're also into the whole job seeking thing, job search, and want to talk about that stuff, stay on my channel, because I will be back in a few minutes with that. In the meantime, if you want to learn more about business, you like this kind of stuff, you want to get into it, consider taking my course. That's a MBA course. It's actually a program. It teaches you everything that you would learn in a full MBA program, which is a 2-year full-time university program. It teaches you all of it. What's the catch? The catch is that it's self-study. So that means it's very cheap, but you do the work yourself. You get a reading list, and you can buy all the textbooks for all the different courses. You can actually get them very cheap for like $10 or something off Amazon or other places. And I provide videos that guide you through it. You're basically reading books, but I guide you through the whole thing with my videos, give you my take on things. And the good news is you can go as deep into it as you want, or you could sort of just back off and you could just skim all these topics and only possibly go into the ones that you're actually actively interested in. So it's very, very flexible. I created it primarily for people that were thinking of being entrepreneurs. They wanted like business knowledge. Business is the scientific study of how to make money, and they wanted that. But it's also useful for people who want to advance in their careers. It'll help you understand business, how making money works. So you'll be more valuable to your employer. And if that isn't all, it's also useful, I found, for people that are actually taking real brick and mortar MBA programs where they're dropping like 5 figures. They want to put their toe in the water, see what it's all about, maybe get ahead. In the beginning, they get my course. So all these people have found it useful. So link in the description if you are interested in that. Other than that, thanks very much. I will see you guys in about 15 minutes. And I'll be back same time next week for another edition of Private Equity Rundown. Take care.